Well, good morning. Yes, it's me, Kenny Polcari, your host of the party. And as you can see on here, or maybe you can't see it, it is Cutlet time. We're going to talk about that in just a moment. Today is Friday, May 17, 2024. And here are the things that you need to know to get your day started. What happened yesterday? Well, the Dow pierced 40,000. But where was all the hoopla? The market continues discounting this multiple rate cut story in 2024, which is illogical to me. There's no eco data today to focus on, so the focus will be on Nvidia earnings next week. And as you can imagine, all kinds of excitement are building around that. Bonds are steady, oil's up, gold is steady. Remember, this is about executing the plan and eliminating the noise as a long-term investor. And what do we have at dinner tonight? Well, here you go. It's chicken cutlet Milanese time. And this apron came to me from a very good friend of mine that loves my chicken cutlets. So Gretchen, here's to you. Anyway, the Momo guys, they focused on the Dow yesterday, right? This after taking the S&P into a new century on Wednesday. They turned their sights to the Dow 30 on Thursday, sending that index up and through 40,000. I mean, who would have thought? I remember being on the floor of the New York Stock Exchange when we celebrated Dow 1000. That was back in 1982. Now, what's really fascinating for me is that I began my career in the New York Stock Exchange in the summer of 1980, when the Dow was trading at about 890. But by August 1982, the Dow had fallen to 790. Recall what was happening at the time, right? We had just come out of the Jimmy Carter years. The economy was a disaster. We elected Ronald Reagan to lead the country into the 1980s. Interest rates were pushing 20%. Unemployment was near 11%. And inflation was running at 6.5%, which was down from 13.5% during the end of the Carter years. I'll never forget it. It was Tuesday, August 17th, 1982. The day the world changed. The Reagan tax cut package had gotten passed. The then Fed Chair Paul Volcker made a surprise announcement on this Tuesday morning at 8:30, telling the country that the Fed was going to slash interest rates by a full 10%, which was equal to 2 full percentage points, taking interest rates from 21% down to 19%. But he laid out the plan. Interest rates were then going to come down. Money moved out of the banks immediately and into the market. And that was the birth of the greatest bull market that the world has ever seen. By the end of 1982, the Dow was trading at 1,046, up 19.5% on the year. By the summer of 1987, the Dow had peaked out at 2722, only to close out that year at 1988, up 2.3%. But recall the crash of 1987. We pierced Dow 5,000 in 1995, 10,000 on my birthday in March 29th of 1999, 20,000 in 2017, 30,000 in 2020, and then yesterday we kissed and pierced Dow 40,000. It's just amazing. In any event, the excitement continued in the morning, at least in the morning, as stocks pushed higher as investors and traders and algos considered the Fed's next move, and stocks marched on. Now, by now you realize that all the excitement is still being built on this idea that there are multiple rates coming. Yet, JJ has essentially convinced the markets that a hike is not on the table, while we're currently holding rates at 5.25%, right? Now, also saying that the most likely next move will be lower. Okay, that's great. You don't have to be a brain surgeon to recognize that. But what the markets do is they discount this move. They react to now what they think is coming. So some think a rate cut is coming in July. Others think it's November. And guys like me, I don't think we're going to see one at all, at least until early 2025. Yesterday, Goldman redefined their position, telling us we can expect a rate cut in July and then another one in November, taking their rate cut scenario down from 3 cuts this year to 2 cuts, right? It was only on Monday when Goldman came out and said that they were expecting 3 cuts in 2024. So you can see how fast the mood changes, right? Others continue to believe that we can expect as many as 3 cuts, while there are those in the camp that said we're not going to see any rate cuts at all. And I, as you know, sit in that camp, because I just don't see it. I don't see the data weakening so much that it demands the Fed make a rate cut move. Remember, 5.25% Fed fund rates are historically normal. There's nothing usurious about it, right? But for a whole generation of asset managers that grew up in this business when the great financial crisis began in 2007, they only know zero rates, right? Think for 16 years we had zero rates. They only know Fed stimulus. They only know that the Fed's going to react if they stamp their feet hard enough. Well, do you really want to know what I think about that? Because that's a whole nother story. The economy, in my view, remains fairly robust. The job market is healthy. CPI, inflation, is still running at 3.7% year over year. And the latest PPI report on Tuesday actually showed that the producer level inflation is turning up. And that suggests that next month's CPI probably has a better shot of increasing rather than decreasing. The economic data points that we see are also not circling the drain. Yesterday's housing starts rose a stunning 5.6%, which is a 21% turnaround from last month's negative 16.8%. The building permits, while weak, were not as weak as expected or not as weak as last month. Manufacturing and services PMIs are all in expansionary territory. Capacity utilization remains high at 78.4%. Now, this data point is on a 100-point scale, which means that currently we're producing at 78.4% of our capacity, which is, again, historically normal. If we push that percentage up through 80, then we start to put pressure on prices, right? So think resurging inflation. And if that number drops into the 60s, then we're going to be in a severe slowdown. Think 1982 style 70.9% or 2009 at 66.7%. So a current capacity utilization rate of 78.4 is far from being at dangerous levels, and it's a far cry from demanding rate cuts. But hey, what do I know? As noted, while the day started out strong, it kind of ended on a downbeat. At the closing bell, the Dow was down 39 points, the S&P was down 11, the Nasdaq gave up 45 points, the Russell lost 14 points, the transport gave up 21 points, and the equal-weighted S&P lost 13 points. So there was nothing so dramatic to write home about. Eco data was mixed. Initial jobless claims and continual claims ticked up ever so slightly. Housing starts surged, yet building permits were down. But up over last month. New York Fed business services were up. Philly Fed business outlook remains positive. Industrial production was flat, while capacity utilization, like I said, remains at a robust 78.4%. Understand that breaking a big round number like 40,000 for the Dow or 5,300 for the S&P or soon to be 17,000 for the Nasdaq when it happens is exciting, but it's really psychological, right? More than anything. What I take away is that the Dow and the S&P are short-term overbought. The relative strength index, the RSI for the Dow, is hugging the 70 line, which suggests overbought. Actually, it's trading at 68.68, suggesting near-term overbought. The S&P is doing the same. The Nasdaq is trading at 65.70, so not overbought. The Russell's has an RSI of 61.48, not overbought. Transports has an RSI of 53.90. That's kind of in the sweet spot. It's neither overbought nor oversold. While the equal weight S&P has an RSI of 65.27. Now, this doesn't mean that stocks can't go higher, because they can. It's just a technical indicator that gives asset managers and traders some insight into the health of the continued strength in the markets at the current time. So what it tells me is that the next move is most likely lower for stock prices. So being patient when allocating new money is probably most prudent at this moment. Remember, you are invested, so there's nothing to worry about. If we go higher, guess what? You are participating. And if we go lower, you can take some of the cash that you got sitting there waiting and use it to dollar cost average, allowing you to be a bit more discerning when allocating new money to stocks. Now, keep your eyes on the VIX, right? That's right, it's near historic lows at 1230, suggesting that there's no fear out there, which is exactly why you need to be paying attention, because it is too complacent. It suggests that there is nothing to be concerned about, and that is not where you want to be when investing. You always want to have this what-if scenario going on in the back of your head so you're not surprised. When the VIX surged by 70% from the March lows to the April highs, the S&P fell by 6%. When the VIX fell by 42% off the April high to today, the S&P gained back 8%. So in my opinion, the next move for the VIX is up, unlike interest rates. So I'm expecting some pressure on stocks in the weeks ahead, right? Not a lot, not a crash, just pressure. Bonds having rallied nicely over the past week. week or so, right? They did back off a bit yesterday, and that pushed yields back slightly higher. Nothing dramatic, just more rebalancing. Oil continues to trade tight. News that China is restocking their oil supply drove markets a bit higher yesterday, up about 9/10 to end the day at 79.40. This morning's oil's trading at 79.10, and we remain in that 78.81 trading range. Gold, which kissed 2,400 on Wednesday after that CPI report, continues to churn at these higher levels, at higher end of this trading range that I identified a month ago. This morning we see gold trading at 23.85, and we remain in that 2,300, 2,400 trading range. U.S. futures this morning are churning. Dow futures are down 12, S&Ps are up 1, Nasdaq's up 6, the Russell is flat. Now, after all this excitement about rate cuts this morning, trader types are now dialing back on what the cuts are expected to be coming and when they're expected to be coming. Yesterday's commentary by 3 Fed members being cited as the reason. And you know what they all said? Come on, you know. They said higher for longer. They did not suggest that rates are going to go up, but nor did they suggest that the Fed is in any hurry to cut rates either, which is also why we saw yesterday's rally kind of fizzle out and today's S&P kind of just churning as it digests the latest move over the last couple of weeks. Right? We're in the middle of an intersection. The global central banks are in this data dependence mode. So let's see what Governor Chrissy Wallace says today, or Minneapolis's Neely Kashkari, or San Fran's Mary Daly, because they're all speaking today. The question is, are they going to mimic what we heard yesterday and all of last week? Is that higher for longer and no rush to cut? That'll be the question. In Europe, the ECB Executive Board member Isabel Schnabel is trying to rein in the idea that the ECB is going to have 2 rate cuts, one in June and one in July, all while swaps traders continue to push the idea that there's going to be 3 cuts before the end of the year. Now look, there's no eco data today to consider, so expect more churn. We haven't heard a lot out of the Middle East, so the market does not appear to be that concerned going into the weekend. But remember, it is exactly then, when you least expect something to hit you, that it hits you. I'm just saying, do not discount anything that is happening or not happening at the moment out of the Middle East. European markets are all a bit lower this morning, down by about 0.2%. This after surging higher for the past 9 days. Eurozone headline CPI came out at plus 2.4%, in line with expectations. Core inflation coming in at 2.7%. That is down from 2.9%, while services inflation dropped to 3.7%, down from 4%. So that is good news. It is moving in the right direction. Now, this is what they're going to use over there in the Eurozone to guide them, to push the ECB to continue the idea of those rate cuts in June. Markets are not really reacting because remember what I said. It's a discounting mechanism. It has already priced in the idea of a June, if not a July rate cut, right? You've seen them up 9 days in a row. So now it's just moving on to the next thing. It's going to churn for a while, and then it'll focus on what's next. The S&P closed at 52.97, down 11 points. And it appears that maybe we're going to take a little bit of a breather after yesterday's rally and the rally the last couple of weeks that took us to all-time highs. With no economic data due out, expect the conversation to be focused on Nvidia's earnings next week. I mean, this stock is up 90% year to date. It's up 213% over the past 12 months. And as you can imagine, this is a very crowded trade. There's a lot riding on what Jensen Huang is going to say about the future. In addition, we're going to hear from Lowe's and Macy's and Zoom Communications. My sense is that, like I said, we need to digest the latest data and the latest move up in stocks. Again, this is why I keep saying, talk to your advisor, create the long-term plan, and then execute it and stick to it. Do not try to pick tops and bottoms, because that never really works as a long-term trader. You just want to continue to invest in dollar cost average in your long-term trading account. Call me to discuss. I'm always happy to discuss it. 212-381-6194. Okay, so now on to the chicken cutlets and this apron, and it's cutlet time. So this goes out to my daughter Amanda and her friends Annie Laura and Gretchen. Okay, so this is like in a simple, basic food in an Italian house. There's always chicken cutlets in the fridge. I mean, my mother always had chicken cutlets in the fridge because you never knew who was going to come over for dinner, and you needed to have something in the fridge you could always pull out and warm up. So for this, you need, very simple, you need thin sliced chicken cutlets. You need seasoned Italian breadcrumbs. We'll get to that in a moment. You need eggs, flour, and olive oil. All right, so for the seasoned breadcrumbs, I use, and I always used, hamburger rolls, right? Just go out and get hamburger rolls or hot dog rolls. put them in the food processor and blend them up to make breadcrumbs. Now, put them in a big bowl. Season it with salt and pepper, onion powder, garlic powder, chopped parsley, and at least 3 handfuls of fresh grated Parmigiana cheese. You can actually mix it and use both Parmigiana and Pecorino Romano cheeses to give it a little bit more oomph. It is so delicious. Mix it well. Now you're good to go. You can save those, put them in the freezer, set them aside, use them for later, use them for something else, use them for pork, use them for veal. But today it's chicken. Now, turn your oven on to broil so that it's nice and hot when you're ready. Now, rinse the cutlets, pat them dry in a paper towel. In a bowl, you're gonna crack 4 or 5 eggs, depending on how many cutlets you're making, and then you're gonna scramble them to make like an egg wash. Then get a large plate and add some flour to that plate. Now, set up the assembly line. You want the flour, then the eggs, and then the breadcrumbs, right? So you're gonna dredge the cutlet, you're gonna pick the cutlet up, you're gonna dredge it in the flour, shake it off so you don't have a lot of extra flour in there, dip it in the egg wash, and then place it into the breadcrumbs using the back of your fork to press it into the breadcrumbs and make sure that you get the cutlet coated on both sides, right? Now, place those cutlets that you coated now on a clean plate, repeat until you've finished coating all of the cutlets. Now, using like an aluminum pan, right, a deep aluminum pan, add enough olive oil that covers the bottom of the pan. Not like you're swimming in it, but you just need to have enough so it's covered, right? Place the pan in the oven on the second rack level from the top. Don't put it right up against the heat, use the second level. Then let the oil get hot. Now, you have to watch this because it heats up fast. Do not walk away from the stove, from the oven at the moment. When the oil is hot, you can check it by tossing in some breadcrumbs. You're gonna add the cutlets one at a time. Put them down, then flip them over, right? Fill up the pan, put them under the broiler and broil them until they're golden brown. Pull it back out, flip them back over and broil the other side till they're golden brown. When they're done, remove them, put them on a clean plate. Once you cool them, you just eat them. Pick them up, you can eat them. And if you don't finish them, you put them in the fridge and you eat them for tomorrow. You eat them for breakfast, lunch, and dinner. They are just delicious. Now, you can eat these plain. You can eat them with fried sweet peppers and onions. You can eat them with a mixed green salad. I mean, you can't really screw this up. They're very versatile. They work with anything. Okay, so look, it is Friday morning. It's just about, sun's coming up. It's just about 8 o'clock. You can see it's kind of cloudy out today. It's not rainy, but it's kind of muggy and humid and cloudy. So I wonder if that says anything about where the markets will be. In any event, I'll be on with Stuart Varney at 9 a.m. this morning, and then I'm on with Maria on Maria's Wall Street on Friday night and then over the weekend. Until Monday, take good care.